Welcome to Morningstar. Today in the studio I have Ian Mortimer with me from the Guinness Global Equity Income Fund, who's going to give us his 3 dividend stocks. Ian, thank you very much for being here. Let's start with your first stock. What is it?
Yeah, so my first stock is Cisco. So this is sort of quite well-known technology company in the US. And I think it espouses quite a lot of the types of characteristics of the businesses we're looking for in our portfolio. And that's in particular, this is more of a sort of modest growth business. We're sort of looking at kind of earnings growth in the sort of mid sort of single digits, so 5, 6, 7% potentially on a kind of longer term basis. And a company that can kind of compound really successfully. It's a business that, obviously doing sort of networks and switches historically in terms of the tech space, I think is developing. I think there is slightly more competition coming in, but it is a company that's also moving into more sort of software and services as part of that. And I think longer term they will ultimately benefit for that move from sort of cloud computing, hybrid working, and other elements as that develops over time. I think you get a pretty healthy sort of 3% dividend yield off it, and that dividend's been growing really healthily. Okay,
so what's your second stock?
Our second stock is a bit different, so now we're moving across to Australia, a company called Sonic Healthcare. So this is one of the world's largest pathology and testing businesses. It's a pretty fragmented market, and they're a company that generally speaking dominates in terms of their market leadership in the kind of the geographies they work in. And I think what's interesting about this stock at the moment is it was sort of a COVID winner, if you like, clearly, sort of testing pathology, and therefore generated significant profits through that period, and now that's falling off. So it's a company actually which looks like, to some extent, is in decline. Returns on capital are dropping, revenues are coming down, but ultimately it's going back to its base business. And we think that base business is really strong. I think that's got the potential to grow at the sort of 10% type level, and it's a company that's grown both organically and inorganically. So it does many, many smaller acquisitions, consolidating that fragmented market. They have a great management team that have been doing that business model for decades. And today, they've got a kind of debt profile that's about 0.5 times net debt to EBITDA. Historically, that's been on average around 1.5. That's sort of their optimum. And the reason that's lower is because all the cash they made during the pandemic period. So actually, I think now they've got quite a lot of firepower, if you like, to go and do some of these acquisitions to boost some of that earnings maybe beyond what the market's expecting, and then hopefully provide that re-rating potential alongside that good growth. And again, this is a company growing dividends at sort of 3% per year, and potentially growing those dividends at maybe double digits.
Cool. So we've been to the US, Australia. Where are we going for your first or third stock?
We're going back to the US, in fact, but a different sector. So we've looked at IT, we looked at healthcare, and our final stock is VF. This is the consumer discretionary stock. So they make things like Vans trainers, Timberland, North Face jackets, and so on. So it's an apparel business. And actually, this is a stock that's really had quite a difficult time more recently. It's now trading, I think, around sort of 8 or 9 times PE. And clearly this was a business that was affected by the pandemic. Footfall fell, people bought less things, particularly apparel, and they suffered alongside other consumer discretionary stocks. Unfortunately, one of their main drivers of their business was the Vans trainers business. This has been a sort of a big growth area for them, and unfortunately that then stumbled. So kind of brands maybe weren't so popular, and so on, and maybe it wasn't managed as well, maybe inventory levels got too high, and that's something the company is now very much focused on tackling. And we think at these sorts of valuation levels, a lot of the sort of bad news, if you like, is priced in. Significant discount to peers. I think the company are doing the right things to tackle the problems they have. And I think interestingly, just a couple of days ago, they announced their new CEO, who's the ex-CEO of Logitech. And I think the medium-term story on that company, I think could be very positive, but it would be one of those that's more at the value end of what we're looking at. The dividend yield therefore reflects that, around sort of 6.5% today.
Cool. Well, thank you very much for bringing these 3 stock picks to us today. For Morningstar, I'm Sunniva Kolostiak.